Hi everyone, Shoop here, and in my video today we're going to talk about expectations versus reality in the stock market. That's a key battle to watch, and that you need to know where to look to track that. So today we're going to talk about how to track the expectations versus earnings in the market, how you can use that to confirm whether or not the move that we're seeing in the market is going to actually stay put. So before I go on, I'm going to give you a chance to scroll below and click subscribe so that way you don't miss out on any of my weekly videos. Because in today's video, we're talking about expectations versus reality, but the bottom line is that you got to track corporate earnings to know how expectations are going versus the actual results. Because the stock market's always forward looking. So that means that it's not looking at what happened in this month or maybe even next month, but what's going to happen in a few months from now. And that is really all about expectations. They're pricing in what they expect to happen over those next few months. And then as the data comes in, as earnings are reported, or as economic data comes out, as we see just other things take place in the economy, these investors are going to adjust their expectations. And then that's the price fluctuations that we see on a daily basis. Is just a simple battle between expectations versus reality, the actual input that's coming in. And right now, when you look at corporate earnings expectations, they're abysmal. This is setting up to be the third consecutive quarter of negative earnings growth for the S&P 500. It's the first time since 2016 and only the second time since the Great Recession that we've seen this type of consecutive drops in corporate earnings. However, the key thing to note, the difference between what happened in 2008 and what happened in 2016 and then what's happening now, is that when you look at corporate earnings, they're coming in better than expectations. So the actual results are better than what analysts were expecting going into the quarter. And that's important because what we saw in 2008 were actual results were worse than what analysts were expecting going into the quarters. And what that means is that the outlook over the next few months, over the next year, was actually worse than anticipated. So once we see that shift start to take place, once the reality ends up becoming worse than our expectations, then it's time to push the panic button and be alarmed in the market. But right now, we're not seeing that happen. And in fact, the last time that it did happen was in 2008. So we know that once we see this, it's a major red flag. What you're looking for is negative earnings expectations and then a worse than expected reality for those expectations. So once the actual results are worse than a negative expectations for earnings, then it's time to be nervous about where the stock market is, and you can expect further losses to come. Because going back to even 2009, when the stock market finally bottomed, what happened was analyst expectations and the actual results finally came back in line. They were actually neck and neck for that quarter that we saw the stock market bottom back in March of 2009. So that's going to be hugely important to keep in mind if you're worried about the economy, if you're worried about where the stock market is headed next. You can use this as a gauge to help confirm whether or not we're going to stay in a bull market and stocks are going to continue to go higher. Or if we start to see volatility, you can use this to confirm whether or not you think the sell-off is going to become a lot worse in the coming months. So a key place to check that out at is factsetinsights.com. They do a great job of keeping you updated on earnings expectations and the actual results that are coming out. And they have a ton of analysis that they dive into there. So it's a great place to go and check out if you want to keep up with this. But if you follow me, you don't have to worry about it. I'm on Twitter, I'm on YouTube, and I'm on my daily and weekly videos. So I'll be on all these different places telling you how this trend is going and when it's time to either panic or to stay with the trend. So right now, the market is telling us to stay bullish. Expectations are worse than the reality. So that's a positive sign. So we're excited to stay in these trades and continue to benefit. Now, if you want to learn how I trade options and how I benefit from earnings season and continue to rack up profitable trades regardless of what's going on in the market, then scroll below and you'll be able to learn more about that and how I take advantage of the swings in the stock market. So until next time, I'm Shoop.